Good morning and welcome to our webinar today, Q2 2014 Investment Outlook. Now, this webinar is part of a series that we do, and it syncs with a series of publications on Investment Outlook, all put out by Siegel Rogers Casey. Today's session is called 1-800-POTHOLE, and our session will describe how we got that title. Let me introduce today's speakers. We have Tim Barron, who's a Senior Vice President and the Chief Investment Officer with Siegel Rogers Casey, and Dan Westerheide, a Senior Vice President and the Practice Leader for our Asset Liability Modeling Practice. Now, I'd like to begin, and we're going to start with Tim Barron.
Thank you. Good morning. This is Tim Barron. While you take a quick look at our disclaimer, let me try to briefly explain this notion of the pothole, this analogy we're using, where we're really comparing central bankers globally, their actions to filling the cracks and holes that still seem to be opening up even now after 5 years have passed since the financial crisis. It's when you're driving along and you see the orange barrels of pothole repair, or if you're concerned that you're going to bounce into some deep hole, well, you just don't drive as fast. So here we are today with the various feds around the globe telling us that they're going to keep their asphalt trucks at the ready, but they're starting to say that the roads generally look smoother now. And that makes us wonder whether or not businesses and consumers are going to start riding along as though the next big jarring bump isn't right around the corner. But, for us, the harsh realities of everyday life, of the economic signs that we see, they suggest to us that keeping one foot on the brake these days may not be such a bad idea. So let's examine some of these influences. Starting, with the kind of the approach we take throughout this is we try to think about the positives and the offsetting negatives and use those notions to end up with an overall picture of the economy and the environment that we're operating in. So if we start with the positive side, we have reduced federal and state and local spending for a long time that was a significant economic drag. Now that's starting to pick up a bit now. Tax revenues have been improving, obviously, with growth, but we're starting to see that be less of a drag on the economy, which is certainly a good thing. But then again, we have the concern of the impact of rising rates on what is still a very large federal budget deficit overall. If you think about it, interest expense today is about 6% of total federal government spending, and what does that number look like if we see a significant uptick in rates? We know that the Fed is determined to keep rates low, but now there's pressure to the upside, and people are starting to think about that time frame sometime in 2015 when the Fed itself says that rates are likely to increase, and most people certainly are expecting that to happen. We have the very ugly-looking Fed balance sheet, and it still has risk in the future. In 2007, the Fed's balance sheet was about $869 billion, and now that's ballooned to over $4 trillion. We know the housing market's an important driver of economic activity. Housing affordability index is up slightly, but still way below the long-term average, and the debt service ratio is the lowest, at least in the recorded history. It's below 10%. Yet we've had an increase in mortgage rates. They're up over 100 basis points in the last year, noting that they're still historically low. But we're not seeing a lot of pickup in housing activity. We've seen pickup in prices, certainly, but not in new home starts, for example.